Professional investors sell the idea that expertise, data, and experience allow them to consistently beat the market. This promise is attractive because it suggests skill can overcome randomness and justify higher costs. In reality, decades of performance data show that most professional investors fail to outperform broad market indexes over long periods. Even when some succeed temporarily, it is difficult to distinguish genuine skill from luck. Markets are highly competitive, meaning prices already reflect available information. When thousands of professionals analyze the same data, any advantage is quickly eliminated. As a result, outperformance becomes rare and fleeting. The gap between expectation and outcome is the foundation of why professional investing often disappoints. Investment fees seem small on an annual basis, but their long-term effect is enormous. Management fees, performance fees, and transaction costs steadily erode returns. A 1 or 2% annual fee can consume a large portion of total gains over decades. This creates a mathematical hurdle that even skilled investors struggle to overcome. Because markets grow at a limited rate, fees take a disproportionate share of profits. The investor bears the downside risk, while the manager collects fees regardless of performance. This asymmetry means professionals can earn well even when clients underperform the market. Over time, fees compound more reliably than skill. Professional investors often attempt to time the market by predicting economic cycles and price movements. These forecasts appear logical but depend on variables that are inherently uncertain. Missing just a few of the best market days can dramatically reduce long-term returns. Those days are often clustered around periods of volatility when professionals are most cautious. Fear of losses encourages selling during downturns, while optimism leads to buying after prices rise. This behavior results in systematically poor timing. Even with advanced models, professionals struggle to act correctly under pressure. The market rewards consistency, not prediction. Professional investors are rewarded for gathering assets, not for delivering superior long-term results. Career risk encourages conformity rather than independent thinking. Underperforming alone is dangerous, but underperforming with everyone else is safe. This leads managers to follow benchmarks instead of challenging them. Short-term performance is emphasized because it attracts clients and media attention. Long-term outcomes matter less when investors frequently move their money. These incentives encourage behavior that protects reputations rather than maximizes returns. The system favors survival, not excellence. High intelligence and specialization can create overconfidence in professional investors. This leads them to believe they can control outcomes in an unpredictable environment. Complex strategies give the appearance of sophistication and justify higher fees. However, complexity often increases risk without improving returns. Financial markets reward simplicity because costs and errors are minimized. Over-engineering strategies introduces more points of failure. Professionals may mistake activity for value creation. Doing more does not mean achieving more. Passive investing accepts that markets are difficult to beat consistently. Instead of trying to outsmart the market, it aims to capture market returns at low cost. By minimizing fees and trading, investors retain more of what the market provides. Over long horizons, this advantage compounds powerfully. Passive strategies remove emotional decision-making from the process. This leads to more consistent behavior during market stress. The success of passive investing highlights the weakness of professional management. Simplicity often outperforms expertise.